Good morning, everyone. Welcome to our Wednesday morning trading session. Hump day. Woohoo! Halfway through the work week. We've only been working a day so far. Because it's holiday week, of course, for those of you outside of North America, Monday was a holiday. All right, let's take a look here. What's been going on with the market yesterday? A little bit of a roller coaster kind of day. The market making some gains early on, giving those back, gaining, giving them back by the end of the session, or part of them back by the end of the session. The overnight, very quiet. And now we're looking at, well, pretty much starting the day from where we left off. And yesterday, the market closing into a big slide to the downside. So, I don't know, it's making the market seem a little bit tippy, especially the really, really quiet overnight sessions. There's no momentum, it seems, to try to move the market higher. Yeah, good question here. Steve is asking, do we have an in-sync eagle signal? We certainly do. We've got a red bar buy signal right there. And when did that one print? Oh, well, it printed right pretty much on the open. So with the eagle, of course, what we're looking for is we're looking for that first in-sync signal of the day. Here was the one from yesterday. And it also looked unlikely, I have to confess, and yet it ended up plotting higher. We do have something that's sort of resembling a triple top up here. Not saying the market can't go up. It is a pretty strong signal. This red bar buy, I suppose you could draw a trend line across the lows as well. And you can see we're getting some sort of support down here. We're getting a mixed bag of signals, though. Yesterday, at least, all our tools were more or less all pointing the same direction. This morning, we've got a bullish eagle. We do have a slightly bearish hawk. Now, we've got a green bar sell signal here. That is our counter trend signal, however. So you could look to buy the failure and look to buy the market higher. We have a falcon here that is also producing a trend change signal. So the trend line changing color. The bar color is going from green to red back to green. That's our trend change signal. And here on the Raptor as well, we've got a cloud crossover. So a few things suggesting that the market may head higher, but it is still very early. We're only a few minutes into the session. Yeah, Clayton says there was a good push at around 3:45 Central. So 3:45, that's 1:45, pardon me, yeah, 1:45 my time. A little bit of a move lower right through here. I think this is the one that Clayton's looking at. Yes, that number 2 signal, that's what Clayton says. Nice, well done. Thank you, Ryman. Ryman reminding me that FOMC minutes are out at 2 p.m. Eastern today, so could be a little bit of a sideways sort of session. Now we're also producing a first micro-macro cross signal here on the hawk. Well, the warning dots anyways. We don't have the complete signal just yet. Maybe I'll take a look, see what's going on with gold and crude oil. So I'll pull the Raptor over here. Here's crude oil. Crude oil looks like it's in a little bit of a slide here. Price is heading a little lower. Had the cloud crossover signal print prior to this morning's open, about an hour and a half before the market opened. Also a little bit on the quiet side. And here we have gold. Yeah, just kind of flip-flopping here a little bit. The market moved a little bit too fast through here to give us our number one signal. It printed. It wasn't a number one I would have gotten on board with. It's easier to see in hindsight. I might have considered this as a soft edge sell, however, right back here after we retested the highs. Good little fall off to the median line, and here we are. So we're pretty much non-committal across the board here this morning. And now we're trying to check out the bottom end of this trading range. Big reversal. So it looks like they're going to continue what they started toward the end of yesterday's session. Okay, now we're at the bottom end of the trading range. We should get a first micro-macro cross printing here in the hawk. Thanks, Steve. Steve says, home sales out at the top of the hour. Oh, well, we're seeing a little bit of a reaction down here, so it's looking like maybe we're just going to continue sideways after all. Just when you think a breakout is coming, the market starts to drift sideways again. All right, well, we do have a warning dot here for the hawk. This is a first micro macro cross lower. I might try this maybe just with a single and look to enter below the low, cover above the high, put a runner on it. All right, here we go. So I think I may delete my break even as well. Just looking to get a little bit of breathing room here before I roll my stops in. Yeah, well, there you go. Floyd asks the age-old question, how do you recognize chop? I have a separate indicator that works for me. That's fantastic. If you have a way that works for you to recognize chop, then, by all means, stay with it. For me, I pretty much just follow what prices are doing. If there's one advantage to day trading, it's that you can see how quickly the bars are unfolding. You kind of get a feel for the market. With the hawk, I look at the bar colors. I don't want to see the bar colors waffling too much. I don't want to see a market moving back and forth without making any progress. I know this kind of looks like the market we're in right now, but we are making lower lows and lower highs. So even though the market is kind of choppy, we do have a little bit of a downward progression. Sometimes you just need to take the plunge, though. I'm not certain about the market, which is why I've only committed a single contract to this trade. This is certainly a position that I should be able to take at least 2 contracts on, but I wasn't sure. So because the market is potentially sideways, right? If we take a look here at the Eagle, where are we at? We're right at the bottom end of yesterday's trading range. And we know that this is normally where the buying occurs, and this would be where the selling occurs. And like I always said before, the safest way to trade chop is, if you suspect the market is sideways, let it get outside of the chop and prove to you that it can stay outside. And likewise on the upside, let it break out and let it prove to you that it can stay outside of this chop zone, and then look for your buying opportunities or your selling opportunities. Okay, hold on here a second, folks. I think I'm not liking the way this is unfolding here. Let's get back to our trade really quick. Shoot. Come on. I was looking for a little bit more of a commitment to the downside. Yeah, that's true. Clayton says we've got a cloud crossover forming here on the Raptor. So maybe I'm panicking a little bit too early. We should see some sort of reaction here as the market gets into the hard edge of the cloud. So very good, Clayton. That's exactly what we've got going on there. Great question here from Tom. Tom asks, Eric, do you take the trade forecaster into consideration? Is it a reliable indicator? And do you take it into consideration when looking at the current conditions? I do, but I always let the prevailing market conditions determine what I'm doing. So let me explain. The trade forecaster, as the name suggests, is a forecasting tool. It tries to predict what the current market condition is and what the next one is likely to be. And it actually works in a very similar fashion to how the weatherman predicts the weather. So what a meteorologist does is they look at cloud formations and humidity and barometric pressure and wind speeds and this, that, and the other thing. And they say, okay, the last time these conditions were present, this is what the weather was like. Therefore, if we have those kinds of conditions again, this is what the weather should be like. Well, the trade forecaster does a similar thing. It actually looks back in the history of your chart. I think you need at least 20 days of data. So it looks back over the last month of trading, and it says, okay, the last time we had these market conditions, this was the dominant phase of the market. So right now it's saying that we are in a trend phase for about another 3/4 of an hour. Now, trend phase does not necessarily mean we will get a monster move like this. Very often it means exactly that, but a better way to look at the trend phase is to think of it in terms of volatility. So when a market is trending, what's going on? Well, you have minimal pullbacks and you tend to have more follow through, right? Most of the time. So when Trade Forecaster is in trend mode, that tells me that, well, I can probably get by with a slightly tighter stop. And I might consider either having a runner in play or perhaps extending my profit objective a little bit because the market should be a little smoother. That might actually be the best word, smoother. Let's go to the other extreme here for a second, down to scalp mode. What is the market like when the market is in scalp mode? Well, it's going to be a lot less committed, isn't it? It's going to be a lot choppier. Therefore, when you're in scalp mode, or when Trade Forecaster is suggesting that we're in scalp mode or going to be moving into scalp mode, we're probably going to be doing the opposite of what we were doing in trend mode. Namely, we're going to be trying to run a wider stop, maybe go all in, all out on target, maybe even run tighter profit objectives. Swing mode, as you might guess, falls somewhere in between. We do expect some follow through on the signals. However, the pullbacks may be a little bit deeper than we would see, say, when the market is in trend mode. So let's take a look here at our trade here this morning. So we produced the first micro macro cross. I took the signal. The market retreated against us a little bit, but it's only so far. It's only a little bit, right? It's not a major pullback. It's not like this first micro macro cross here, and that came in the wee hours of the morning. And unfortunately, I can't tell you what the market or the trade forecaster suggested the market mode was at that time. But if I had to guess, I would say it was either in swing mode or very likely in scalp mode. And I say that because look at the depth of this retracement. So, you know, I have a tendency to run a slightly wider stop anyhow, but that's kind of the way I like to use the trade forecaster. And yes, it's surprisingly accurate. Hopefully it will hold true this morning and we'll actually see a little bit more follow through on this signal that I'm involved in. But yeah, that's a great question, Thomas. All right, the big deal now is this low. Steve is asking, would you move your stops to the new little swing high here? Not yet, Stephen. I would wait until we break the low. Well, right now I would wait until we break the low. If we take too long here and we can't break the low, then yeah, I might chicken out. Yeah, all right. I think I will chicken out actually. All right. We'll hold there for a little while. Maybe give it an extra tick. Okay, let's put up or shut up time. The market's either going to go or I'll take an early stop out and look at re-entering. The deeper stop definitely would give me more staying power. It's above the high of the morning. But I must confess I'm a little concerned about the lack of follow-through. looks like they're going to give us a little bit of a push here. A little bit of a spank. Great questions here, Steve, and I'm just going to deal with Elmer's question first. Elmer asked, how can we set the daybreak lines on our chart? So what you want to do, Elmer, is go to your data series, and down here you will see session break line. Click on that. By default, it's set at silver. If you don't want to see it, change it to transparent. Or if it's too much, too dark, the dim gray works well. And then you can also change the line itself from a solid line to perhaps a dotted line. That's usually pretty inconspicuous. Great question here from Steve. Steve asks, how often have you taken a full stop? That would take 4 trades to make it back at the initial stop we did. So this is the challenge that faces us as traders. What do we do with our stops? Where do we place our stops? So this is where we got in. The initial stop was back here, and it was to the tune of $200 or something like that. So it's a balancing act, to be sure. First off, the first part of Steve's question, how often do I take a full stop out? Not that often. When you run a larger stop, there's usually at least one opportunity to adjust your stop, to adjust your trade. So the deeper you keep your stop, the more likely it is that you're going to have that opportunity. So for instance, if I didn't put my stop there, if I put my stop way up here, the chance that the market's going to run all the way up here before giving me at least one opportunity to adjust the trade is pretty remote. It can happen, of course, but it's extremely, extremely unlikely. The closer you place your stop, the less likely it is that you're going to have an opportunity to adjust it. So you're kind of putting yourself more in harm's way, right? So you see that I just got stopped out down here, and yes, the loss was less. It was $80. Okay, it's not a deal breaker. But had I left my stop up here, I would not have an $80 loss yet, would I? But you are correct. If I do end up taking the full stop out and getting tagged for $200, the next 3 or 4 trades are going to be to make that back. I think it's, you have to find what works for you as a trader. For me personally, I hate getting tagged only to watch the market go in my direction without me. Because now I've got to think, okay, well, do I recommit to the market? Do I buy in again or sell again? Or do I let it go and look for another opportunity? What do I do? So you can see, we'll run this one out for a little bit and I'll show you what we could do with the wider stop. If the market had a little more commitment to it, I would, um, I probably would have run the wider stop. And here, actually, before we leave this, I'll show you a very, very simple way to roll your stops, or when it's time to roll your stops. Obviously, when the market, here, let's pick a signal. Is that one getting any follow through? Nothing's getting any follow through here this morning. I got to go back a little ways to make my point. All right, so let's say we took this first micro macro cross signal right here. This guy right there. And let's say we set up our initial stop to look something like this. It's a first micro macro cross. It's a high probability signal. We should be able to reach our profit objective at least. How do we know when it's time to start rolling stops? Well, you could just do the simple thing and, oops, we're way up there, and engage one of our stop strategies. However, that may be a little bit too tight to start. I like to roll stops when we take out swing points. So in this case, when the market traded through this high, or these highs right here, that's when I would start to roll my stop. So at this time, I may go to the automated strategy and just let the market play it out. Or if I choose to keep rolling my stops manually, every time we break a swing point, that's when I would start to roll my stops up. And I would roll them below the last swing point. I really like the swing high-low strategy because I think it's a very fundamentally sound strategy. And let's say we had another swing right here around midnight, so then I would roll my stop now underneath here. So we broke another swing here, roll my stop again, and that's an easy way to know when it might be time to roll your stop. Now, of course, if I were in from all the way down here and I nursed this trade into the wee hours of the London session, by the time I had this much open profit, I would be running a very, very aggressive stop strategy, something like parabolics, maybe something like the bar high-low. So that's a simple way to know when it might be time to roll your stop. You kind of let the market tell you. Well, you guys got great questions going on here today. And I will get to all of them. Just be patient with me. Peter's asking, Eric, is there a document with the Raptor high probability profit targets? No, not yet. Adam's got it on my to-do list. But the Raptor targets are really the same as the Falcon targets. Namely, we're going to be looking for $100 per contract. So what that means is you need to divide 100 by whatever the tick value is of the market you're trading. In the case of the NASDAQ, it's $5 a tick, so we would have a 20 tick target. If you're trading a $10 instrument, you would have a $10 target, or pardon me, a 10 tick target. I will mention that with markets like crude oil, the Russell, things that tend to be a little bit more volatile, I will double the profit objective. Here we go again. So we're getting our number one signal, our cloud crossover. And it looks like we're getting a second push maybe on this signal. And can I cover it up there? Yes, I can. Yeah, it looks like they're going to be pretty content to go sideways here this morning. At least for the time being. I just want to make sure I'm not missing anybody before I get to Tom's next question here. So Tom asks, currently having just been stopped out, what's going on in your mind psychologically about having moved the stop? Are you okay with it, or do you internally think you should have left it where you originally set it? Can you please tell us what's going on in your head about your stop change? All right. Well, first off, let's go back to the trade here. So we were short from here. My initial stop was up here. You see this here, this little swing here, and how the market gave me at least a couple bars lower? My stop would now be right there. So I would have reduced my stop, albeit not as drastically as the one that actually tagged me. The only time I feel really bad about getting stopped out prematurely is if I didn't have a good reason for rolling my stop in. Now, I'm not, too terribly upset about it. It was a small loss. It's not like I, played the whole 2% amount and sucked up, a $400 loser. I went in here, covered up there, and I lost $400. So I'm not terribly upset about it. But I do like to have reasons for adjusting my stops. There is something that I call a good loss. And, it seems like a contradiction in terms, but a bad loss would be this trade, right? Setting up your trade so tight that the market doesn't even have a chance, and then you end up getting stopped out prematurely. To me, that is a bad loss. A good loss is setting up your trade, doing everything right, giving the trade a chance, rolling your stops in, and the market still stops you out. Then it's just one of those things where the market is just not in a cooperative mood. And it's very likely because of the FOMC meeting. We're probably just going to see it range back and forth here today. So I think, Tom, when you place a trade, you need to be comfortable with the amount that you have in play. I'll share a story with you that I've mentioned before, but when I do one-on-one coaching with people, there's always that day where we finally go live, right? we do a live trade. And the fellow I was trading with, he said he was ready, and okay, we go do the trade, and he says, well, what do you think of this signal? And I said, well, you know, it's your money. I can't really tell you how to spend your money. And in the back of my head, I'm thinking, I just don't want him to blame me if the signal turns out to be a bad signal. But according to his trade parameters, it was a decent signal. So he ended up taking the trade, got into the trade, and the market went a couple ticks in his favor. And I can hear him talking to himself, under his breath. And he's saying, oh, okay, all right, the market's moving in our direction. That's good, I'm okay. And then the market starts to back up on him. Well, most of us would just get a little bit quiet. Not this fellow. He started calling himself down and, you stupid this, and oh, what an idiot, I can't believe I did that, and this, that, and the other thing. And then the market started to move a couple ticks in his favor. And, oh, okay, all right, the trade's going to be okay. And then the market started moving against him. I said, oh, you idiot, how could you do that? What a stupid thing to do. And the whole time I'm thinking, why are you trading? You are going to take losses when you're trading. And it wasn't a big amount. He was trading a large account. I think it was like a $70,000 account. He had $200 on the line. Like 0.75% of his trading capital. Not even. And he's getting all bent out of shape because the market's moving against him a couple of ticks. Listen, folks, I got bad news for you. If you think you're going to be finding just all winning trades and never sucking up a loser, you are in the wrong business, because there are days like today where the market is just not cooperating. There was nothing, absolutely nothing wrong with our first macro cross signal down here. Perhaps the only thing I did wrong was I didn't leave my profit objective in. So let's see. Did we hit our profit target? Stupid thing. Come on here. Let's try this again. So let's say I set up the trade like so. No, didn't hit the profit target. Should have hit the break-even trigger. So I could have got a break-even stop out here instead of an $80 loss. So if I didn't take the early stop out, I would have certainly been stopped here. So it looks like I would have lost maybe another $20 or $30 on the trade. But that would have been a good loss. Yes, it's a loss. Yes, I don't like to see negative numbers in the P&L, but it's certainly not going to wipe me out, right? I can recover that in a trade, or at the worst, two. So I think you need to be comfortable with the amount that you have in play, so that if you run into the kind of day like we're seeing today where the market's just not committed and you take a losing trade, you're not going to be muttering under your breath all day, telling yourself what a stupid person you are and how could you be so stupid as to take that trade. And I'm not talking down to anybody here. I've been the same way. Ooh, I remember early on I took a $900 loser one morning, and I was fit to be tied. Oh my gosh, I took the dog for a long walk down the trail, and I was not very kind to myself, to put it mildly. And I really got bent out of shape. But here's the important part. This is why I keep a trading journal. I don't ever review my trading journal, or very, very, very rarely do I review my trading journal. But what is important about your trading journal is when you have a trade like the one that I took this morning, and it didn't work out, I will make notes in my trading journal why I think the trade did not work out. Well, okay, note number one, FOMC day. I should have gone all in, all out. I should have left my break-even trigger in play. Both those things would have saved me $80. Was I too quick with my stop? In hindsight, no. So it was a good stop out. It was good that I got on that when the market looked like it wasn't going to follow through to the short side. So that's a positive, right? That's something I can take away from today. When it looks like the market's not going to follow through after a couple of bars lower, bring your stop in. Okay, note to self. So when you do take a losing trade, take a moment and just try to see what went wrong. Was it something that you did? If so, don't do it again. Was it the overall market conditions that you have absolutely zero control over? Well, then the question becomes, did you manage the trade to the best of your ability? And if the answer there is yes, then hooray, you just took a good loss. Days like this don't occur very often, but it seems like once every 3 or 4 months we get these kinds of days where the market just does not feel like cooperating. You buy, the market goes down. You sell, the market goes up. I'll usually give the market 2 trades, 2 high probability trades, and if it fails on both, then it's all right, something's not right with this picture and it's time for me to go do something else or to move into sim mode. So what I would mean by that is, let's pretend for a moment we don't have all these yellow bars printing here, suggesting that we're in a sideways range. But let's say I took a first micro-macro cross lower right here, and it did not even get to its profit objective. Okay, that's very unusual. We don't have it yet, but let's pretend we get a first micro-macro cross to buy up here. And let's say that it also does not get to its profit objective and rather reverses and ends up stopping us out after a prolonged period of time. You know, similar to this. We gave this trade every opportunity. It did not work out. So let's say the same thing happened up here. What are the chances that we would get 2 very high probability signals back to back, and opposite signals no less? You know, if the market's not going to go down, there's a very good reason to believe it's going to go up. But what are the chances that we would get 2 high probability signals back to back and both signals fail? No, those odds are very remote. You know, if the market's not going to go down, it produces a buy signal and then it doesn't go up. No, there's something wrong with that picture. And if that happens to me, then I say, all right, it's just, you know, one of those days that comes at you out of the blue. Let's just leave it alone today. I'll come back tomorrow. The last thing I want is to keep trading on a day like today and end up down $1,000 or $2,000, or I've met 2 people on 2 separate occasions who have blown up a $20,000 account in a single day. One person $20,000, the other $25,000. Whew, I was mad when I lost 900. Can you imagine me if I blew 20 grand, if I blew up a whole $20,000 account in a single day? So, you know, it's all about capital preservation. And if you notice the market is sideways, which it certainly seems to be, you need to take steps to protect yourself, but that doesn't mean that you're, going to walk away from every trade. You can see we have had some follow through here. We got the soft edge buy signal here. That's looks like it's rallied enough to find our profit objective. Hooray. But it is tough to take a loss, but like I said, there is such a thing as a good loss. So be comfortable with the amount that you have in play. I don't know if you're a gambler, Tom, but if you go to Vegas and you're playing craps or cards, once you put those chips down, they don't belong to you anymore. So you got to be comfortable with whatever amount you put on the table. And that's exactly the way it is in trading as well. Exactly the way it is in trading. You have to be comfortable with that amount that you put on the table, on the trading table. Funny thing is, the fellow who I was just telling you about, who was so upset about his $200 loss, he's a prolific gambler. He loves the casinos. We both like playing craps, and he was telling me about his crap strategies and stuff. And of course, he tells me about all his winning days, as is the case with most gamblers. But yet he would think nothing of going to a craps table and laying $200 on the table to play. And, he'll roll craps and away go his $200, and he'll lay another $200 down. And what do you think you have more control over, the markets or the craps tables? You have control over neither. The market will do what the market will do. And if it looks like we've got a decent setup, then we trade it. It's like when Ray Burke and I first started working together. And this is way, way back when we were just starting with the Raptor signals, or pardon me, the Raptor signals, the DTS signals. And we would be looking at trades, like we spent a lot of time with the Hawk, and it would always be, well, Eric, do we take this signal? And Ray caught on pretty quick. That's one thing about Ray. He's not slow. Ray would say, well, Eric, do we take this signal? And I would say, well, Ray, can we afford it? So it always boiled down to, if you can afford the risk, you take the trade. It's as simple as that. You're producing a high probability signal, a signal that has a very good chance of meeting its profit objective. Do we take the trade? Well, can we afford the risk? Yes, we can afford the risk. Okay, let's take the trade. And that's how trading works. There you go, in a nutshell. There's the mysteries of trading revealed. If you can afford the risk, you take the trade. If you cannot afford the risk, you do not take the trade. I know I kind of beat that one to death, didn't I? But it's a great question, Tom. Like, I'm so glad you asked that. A lot of people pay very little attention to the risk side of the trading equation, to the money management side of the trading equation. So, it's very refreshing to see you thinking along those lines. I think that's great. Yeah, Clayton's asking, what do you think about doing a OCO order at the support and resistance lines? That's one cancels the other. You know what, Clayton? I'm not a huge fan of OCO orders. You will see me do them on sometimes on the crude report, sometimes if the market is really, really congested. The problem with an OCO order is that you're trading a breakout, right? And I had a trading friend, you talk about drilling things into your head. He was the one who always said to me, never trust a breakout. Why? Well, I guess if I tightened these parameters here a little bit, you can see why. Look at what happened here this morning to our trade, right? We got a breakout, but no follow through. And how many times do you see that kind of stuff happen? Where you'll get a breakout, you know, a couple ticks higher or lower, and now I can't find you a decent example, but we've all been there. You get a breakout above the high. This is more obvious on a, say, a time-based chart. This is more of a problem. The mean wrinkle bars actually filter out a lot of those false breakouts. But you'll get a little bit of a breakout higher or lower, and then the market will fail. So you get a teeny tiny breakout here to the short side, and then the market rallies up. This is why I say if you identify a sideways range, there's nothing wrong with letting the market get out above there, prove that it can stay out, and then look for the signal. So if I'm going to do an OCO order, and I've identified a sideways range, I may wait for this little hesitation, and then I'll put my OCO up there, and maybe my OCO to sell down there. Obviously, you know, this is a pretty substantial range. But that would make for, this would make for a much more predictable OCO type trade. Especially in a market that seems to be wandering sideways. When you have a market that has a little bit of a trend to it, well, that's not going to be a good example either. All right, well, here we have a little bit of a trend already, right? We got a little bit of a trend, and then we kind of enter this sideways mode. Now look at what happened to these breakouts. We broke here, prices failed. We broke here, prices reversed again. So if you had bracketed this as an OCO, you would have got stuck on both sides. Both sides failed. But if we wait for the breakout and the retest, so there's the breakout, now here comes the retest. Now if we do our OCO and we say, yeah, okay, I'll buy you above there, and I'll short you below here, then you have a better opportunity of staying on the right side of the trade. Traders are tricky. You know, sellers know there's a lot of buyers looking to buy a breakout above here. Buyers know there's a lot of sellers looking to short on a breakout below here. How do we know the sellers are going to overwhelm the buyers? Well, unfortunately, we don't until this point right here, where the sellers all of a sudden have, the market has retested the high and failed. At this point, if you were long this trade, you should say, okay, things aren't looking so good. I'm going to roll my stops in a little bit. And then you end up taking an early stop out. Now the sellers are all cocky, and they look to short down here, and all of a sudden the buyers start to knock them down. Now they didn't really get as much of a reversal as the buyers did, but this bar right here was struggling. I can tell because the bar is wider, and I can tell because it has a tail on it. So at that point, you would have rolled your stop in and you would have gotten an early stop out on that as well. So we can't ever be 100% sure who is going to be the stronger, but I will tell you that once you identify a trading range and once the market gets outside of that range and retests it, then you can look to buy and sell with more confidence. So the OCO orders are great, but they do have their place. You don't want to get too flippant with them because look at what's happening here. We broke the high in the morning, and now what? Where's the follow through? Nada. Zip. Big old nothing burger, like my friend likes to say. Oh, way to go, Tony. Right you are. Tony says that nice late filter entry signal here in the NASDAQ paid off. Well done. Yeah, so the late filter entry, this also piggybacking on a trend change signal. We've got the filter going out of sync, coming back into sync, trend line never changing color. That's muy importante. And then we got the nice little follow through, but just enough to find our profit objective. And so far, no more. And that's the kind of day it is today. We're just, the market's very, very happy where it is. Cleveland says, fickle is what they are, a strange breed. Yes, that's the traders in reference to the traders in the markets. Clayton asks, how do you get the wider bars? That's actually the indicator warehouse. Here, we'll go here and go to your data. This is the dynamic equivolume bars from indicator warehouse. For those of you unfamiliar with equivolume charting, equivolume charting was developed by a fellow by the name of Richard Arms. He's also famous for his trend indicator, which a lot of traders like to watch, but regardless, he wanted an easy way to incorporate volume into his charting. Because, sometimes a volume chart can be a little bit difficult to interpret. We throw a volume chart on here. So, a volume histogram is not always the easiest chart to read, and yet we all know that volume is important to trading, right? We were just talking about breakouts, but the rule of thumb is that you want to see volume on a breakout. You want to see market participation as prices are moving higher or lower, whatever the case may be. Well, he didn't like the way volume charts looked. They were too difficult to interpret. So what he said, and this is actually quite brilliant, is the bars that had more volume would paint wider, and the bars that had less volume would be narrower. So what's interesting to note is that, at least with the mean wrinkle bars, when a market is trending, it's actually trending on light volume, right? It's not wasting any time. It's printing a bar, printing a bar, printing a bar, and so on. Away it goes. However, when the market encounters support or resistance, all of a sudden the bars start to get a little bit wider. And that's because we're seeing more buying down here, and we're seeing sellers trying to sell a breakout. We're seeing buyers trying to buy a breakout. We're seeing sellers trying to knock them back down. So that's why there's more volume associated with the turning points. Jim, one of our DTS owners, loves the dynamic equivolume bars because what he'll do is he'll just look back on the chart and he'll say, okay, there's a pretty fat bar right there. I can anticipate that there's going to be some resistance around these prices. And sure enough, The market gets back up here and it turns down. Or he'd be looking at these levels through here and saying, yeah, okay, this is a definite zone of support. If prices get back down here, they're going to fumble and probably head higher. And that's exactly what happens. So they're very helpful for trying to gauge the overall market feel. Got going on my soapbox today, but it doesn't look like we missed too much. That one signal through there. And we're just kind of flip-flopping again. Just back and forth. Trading like this in this kind of aimless market is difficult for us, but you know what? It's actually a very happy market. The market is very content to be trading around 53.50. The market, traders, everybody feels at 53.50. Yeah, that's a pretty fair valuation of the NASDAQ right now. So it's a little bit tough for us, but like I said, that's what traders are liking. They're pretty happy with it. Well, yeah, see, Steve is asking, is the recent micro-macro cross a good trade considering the highs? Well, that's the issue, isn't it? We just normally, if I got stopped out of a short trade, I'd be all over buying the reverse. But we're just too sideways here. And like you said, we're near these recent highs. If I were to take it, I would probably make a new high. And I certainly would not go in heavy. I'd probably switch here to manual mode, just throw a single on it, see what happens. Oh, way to go, Tony. Tony's been watching gold. He said gold just paid off in spades off of a nice number 3 signal. Let's take a look at that. Look at that. Way to go, Tony. I should be spending less time talking, more time trading. Fantastic. That's a beautiful move. So beautiful little hard edge bounce here. And that just unwound in like a minute. Way to go. All right, boys and girls. Today is also demo day for me, so I'm afraid I'm going to have to close up the room here in a few minutes and get ready for that. So if you have any more questions, please ask away. The way the market is moving right now with its lack of commitment, pretty much forces me to run a deeper stop. So we're getting the number 1 buy signal here. You could do a second push on this one. So we've allowed the signal to engage. It's retreating from the signal. We could look to buy on the next move higher. But you need to really run a deep stop. The reason being, if the market is going to stay in the sideways range, right, this is where the sellers are selling. This is where the buyers are buying. And they're just a little bit too balanced here today. Maybe a second push is the way to go. And here they are peeling back against the uptick a little bit. All right, gang. I'll see you tomorrow again. Like I said, I've got to get ready for the presentation. But be careful. I don't think we're going to see a lot of follow through here with that FOMC meeting just around the corner. All right, I'll talk to you tomorrow. Bye for now.